Michael Saylor built his entire empire on 3 words: never sell Bitcoin. For 5 years, he repeated that phrase like scripture in every interview, every conference, every shareholder letter, and every podcast appearance from Miami to Tokyo. But on May 5th, 2026, in a single sentence buried inside of Strategy's Q1 earnings call, he quietly reversed it. The same week, his company posted a $12.54 billion net loss, the largest in its history, driven by a $14.46 billion unrealized markdown on 818,334 Bitcoin. And the truly extraordinary part is what that one sentence has now done to the corporate Bitcoin treasury narrative that $60 billion of equity value was built on top of. Over the next few minutes, I'll show you exactly what Saylor said, what the numbers actually look like underneath the press release, and what every Bitcoin holder needs to understand before the rest of the market catches on. My name is Lewis, and you're watching The Coin Bureau. Now, before we get into the Saylor quote itself, you need to understand the gap between 2 documents that were published on the same exact day. The first document is the Q1 2026 press release. That's the marketing. It frames the quarter around continued accumulation, the strength of the preferred shared stack, and the long-term Bitcoin standard thesis Saylor has been preaching since August of 2020. The second document is the earnings call transcript, and that's the legal record. And inside that transcript, Saylor said something that contradicts the entire foundation of the press release. The exact words on a recorded call in front of analysts were these: "We will probably sell some Bitcoin to pay a dividend just to inoculate the market and send the message that we did it." Yes, read that again. Inoculate the market. This is the same Michael Saylor who in 2020 publicly compared selling Bitcoin to selling your house, then your dog, then your kids.
There is no second best.
The same executive that in 2023 told an interviewer that his exit strategy was, in his words,
how do you see, what is the exit strategy then for Bitcoin, for you?
There is no exit strategy.
There is no exit strategy. The same CEO who, as recently as October of last year, wrote in a shareholder letter that Strategy's commitment to permanent Bitcoin accumulation was, quote, structurally inviolable. And of course, we should absolutely trust that a phrase like structurally inviolable means exactly what it sounds like, right up until the quarterly dividend bill comes due, right? Now, before we get into why that single sentence has rewritten the entire institutional Bitcoin thesis, you need to understand the financial position that forced it. Strategy holds 818,334 Bitcoin at an average cost basis of $75,537 per coin. Total acquisition cost, roughly $61.81 billion. In Q1 2026, the company recorded a $14.46 billion unrealized markdown on those holdings, driving a net loss of $12.54 billion. Yes, you read that right. $12.54 billion in one quarter. To put that into context, this is the largest single quarter loss in the company's 36-year history, and it dwarfs every prior loss Strategy has ever booked combined. But the markdown on the Bitcoin position is only half the story. The harder half sits on the other side of the balance sheet, in the preferred share stack that Saylor built across 2024 and 2025 to fund the accumulation engine. That stack now has 3 tickers. STRK, the convertible preferred, currently trading at $78 against a $100 par value, which is a 22% discount. STRF, the 10% perpetual preferred nicknamed Strife, trading at $100.61 with a roughly 9.94% effective yield. And STRC, the variable rate perpetual nicknamed Stretch, sitting essentially at par with $27.75 billion in market cap and over 2.3 million shares of daily turnover. Combined, this preferred stack creates an annual dividend and debt service obligation of approximately $1.5 billion. And on the May 5th call, Strategy disclosed that the USD reserves currently allocated to those obligations cover roughly 18 months of payments. That is the entire run rate before something has to give. Either the equity flywheel reignites, or the preferred dividends stop, or the company sells Bitcoin to plug the gap. And on the same call, Saylor told the market which of those three options was on the table. Polymarket has now repriced the probability that Strategy sells Bitcoin before December 31st, 2026 from approximately 10% on April 27th to 48% by May 6th. That is a 38 percentage point repricing inside of 9 days, triggered by a single sentence on a single conference call. For Strategy, its accumulation model depends on one variable, the premium of MSTR's market cap to the value of its Bitcoin holdings, a ratio called MNAV. When MNAV exceeds 1, the strategy can issue equity at a premium, deploy the proceeds to acquire additional Bitcoin, and thereby increase Bitcoin per share. When MNAV is below 1, the same equity issuance becomes mechanically dilutive. You are selling shares at a discount to the asset that they represent, and every new share destroys value for the holders already in the stock. In November 2024, at the absolute peak of the bull market, MNAV hit 3.89. The market was valuing Strategy at almost 4 times the worth of its Bitcoin. By November 12, 2025, MNAV had collapsed to 0.97, the first time below parity in the company's history. By January 2026, it ranged between 0.83 and 0.94. As of early May 2026, it sits at roughly 1.23, and management has openly stated that selling Bitcoin becomes accretive to shareholders below a 1.22 MNAV threshold. Put simply, Strategy is currently sitting one bad week of Bitcoin price action away from the level at which its own management framework justifies turning into a seller. And here's the part that most coverage entirely ignores. During the week of April 6th through April 12th, Strategy issued $0 of common stock. The entire $1 billion of weekly capital raise came from STRC preferred issuance instead. That is not a coincidence. That is the equity flywheel showing its first visible signs of mechanical strain, and management quietly shifting to the only instrument that still works. Now, you might assume that this is a strategy-specific problem, that the over 800,000 Bitcoin sits inside an idiosyncratic capital structure that doesn't generalize. However, that assumption ignores what has happened across the entire crypto treasury cohort over the last 6 months. Firstly, Bitmine Immersion Technologies, the most aggressive Ethereum treasury vehicle of the cycle, is down approximately 86% from its 52-week high of $161 to roughly $23. The 6 months ended February 28, 2026, and produced $9.02 billion in unrealized digital asset losses on its 5.18 million Ether stack. SharpLink, formerly SharpLink Gaming, the second largest Ethereum treasury vehicle, is down over 90% from its 2025 highs. On April 3, 2026, the company filed an 8K, disclosing the termination of its discretionary management agreements with Parify Capital and Galaxy Digital, effective May 31st. The official framing is that SharpLink is bringing treasury management in-house. The honest framing is that paying outside fees on a position that has lost 90% of its market value is no longer a luxury the balance sheet can sustain. And on April 8th, the 1.6 billion Ether machine SPAC, the merger between Dynamics Corporation and an Ethereum treasury vehicle holding 496,712 ETH, collapsed entirely. The mutual termination citation was, in the language of the filing itself, unfavorable market conditions. Translation: the SPAC sponsor and the target both walked away from a deal that was supposed to be the next great institutional ETH allocation vehicle, and one party owes the other a $50 million breakup fee for the privilege. And of course, we should absolutely trust that the corporate Bitcoin and Ethereum treasury model is structurally sound, right up until the third largest treasury vehicle quietly fires its outside managers, and the fourth one collapses before it can even list. The historical precedent here is exact. In 2022, Three Arrows Capital was the largest crypto hedge fund on Earth, managing approximately $18 billion at its peak, built on a single concentrated trade, GBTC arbitrage at scale. When the GBTC premium inverted into a discount that reached 34% below NAV by June 17, 2022, the leverage that had built the position became the leverage that liquidated it. Three Arrows defaulted on $665 million owed to Voyager Digital alone, was placed into BVI liquidation on June 27th, and the cascade took down Voyager, then Genesis, then DCG. Celsius followed almost immediately. The platform attempted what its executives privately called controlled liquidations of its ST-ETH position to manage redemption pressure. Each visible on-chain sale signaled distress, accelerated the bank run, and forced the next sale. On June 13th, withdrawals were halted entirely. By July 13th, the company filed Chapter 11 with a $4.7 billion shortfall. The mechanism that destroyed Three Arrows Capital and Celsius was not the asset. It was the capital structure wrapped around the asset, combined with the visibility of any forced sale. Which brings us directly to the part that should concern every Bitcoin holder watching this. Saylor's exact phrase on the call was "inoculate the market." That is the same conceptual framing Celsius executives used in June 2022 to describe their controlled ST-ETH disposals. The premise is identical. A small, visible, deliberate sale will demonstrate confidence and stabilize sentiment. The historical outcome is also identical. The visibility of the sale becomes the signal that confirms the underlying distress, and the small inoculation expands into a much larger forced unwind. Now, look, strategy is not Celsius. Saylor does not have ST-ETH liquidity issues. The convertible debt that previously sat on the balance sheet was largely retired during Q1 2026 through equity conversion, dropping total debt from $8.28 billion to $136.9 million in a single quarter. That is genuinely structurally important, and it deserves to be acknowledged honestly. But the preferred shared stack does not retire. It compounds. The $1.5 billion annual obligation does not pause for a Bitcoin drawdown, and the 18-month runway that management disclosed on May 5th, well, that is the same runway whether MNAV is 1.27 or 0.83. Which brings us to the part of the story that most crypto channels are too scared to actually say out loud. The corporate Bitcoin treasury narrative was sold to retail holders for 5 years on the assumption that the largest committed institutional buyers would never become sellers. That assumption just expired in writing on a recorded earnings call in front of regulated equity analysts by the single executive who built that assumption in the first place.
There's a crypto asset, it's called Bitcoin, right?
And the deeper consequence is not just about strategy. It is about every product, every ETF, every corporate vehicle, and every custodial wrapper that you may currently use to hold Bitcoin exposure. Approximately 84% of all US spot Bitcoin ETF assets, roughly $77 billion across 9 of the 11 approved funds, sit with a single custodian, Coinbase custody. One regulatory order, one cyber incident, one insolvency event, and the majority of the institutional Bitcoin ETF complex faces the same problem at the same moment. The self-custody holder sitting with private keys in a hardware wallet is entirely outside that blast radius. The MSTR shareholder is not. The IBIT shareholder, well, is not. The corporate treasury exposure built through equity wrappers is not. And the historical pattern here is brutally consistent. Every prior cycle has produced an untouchable holder that the market believed would never sell. In 2014, the US Marshals were going to hold the Silk Road Bitcoin permanently as evidence. They auctioned over 144,000 coins. In 2021, Germany was going to hold the Movie 2K seizure as a sovereign asset. Between June and July 2024, they sold all 49,858 coins at an average price of $57,900, missing over $3 billion in subsequent upside. GBTC was going to be a permanently locked Bitcoin trust. Since the ETF conversion in January 2024, it has shed approximately 464,000 Bitcoin in cumulative outflows worth roughly $26 billion. And in 2022, Three Arrows Capital was going to be a long-term holder of its leveraged Bitcoin and GBTC stack, right up until margin calls forced the largest single crypto hedge fund liquidation in history. The pattern does not break. Every entity described as permanent eventually has a price at which the math forces a sale. The only question that has ever mattered is which entity reaches that price first, and how visible the sale becomes when it happens. So for you, the practical implications are concrete and they are immediate. First, watch the on-chain wallets. Arkham Intelligence has identified over 1,400 addresses linked to Strategy's treasury, and any meaningful outflow from any of that cluster towards known exchange deposit addresses is a leading indicator that the inoculation has begun. Second, watch the MNAV multiple weekly through the block's premium to NAV dashboard. If MNAV stays below 1 for 4 consecutive weeks, analysts have flagged that as a structural threshold at which the equity flywheel enters what they describe as a passive mode downward spiral. Third, watch the STRC capital raise pace. If weekly preferred issuance decelerates while common equity issuance remains paused, that is the combined signal that both halves of the funding model are stalling simultaneously. Fourth, question the concentration risk inside the products that you currently hold. If your Bitcoin exposure runs through an ETF, you are exposed to Coinbase custody. If it runs through MSTR equity, you are exposed to the preferred shared dividend cycle. If it sits on an exchange, you are exposed to the same counterparty model that defined every prior cycle's collapse. And fifth, recognize that the long-term structural implication of this story may actually be bullish, even if the short-term implication is the opposite. If supply transfers from leveraged corporate hands to patient, self-custody holders over the coming quarters, the float held by reflexive sellers shrinks, and the float held by genuinely permanent holders grows. That is not a panic outcome. That is a clarity outcome. So here's the synthesis. Saylor's reversal is not the end of Bitcoin's institutional story. It is the moment that that story becomes honest. For 5 years, the corporate treasury narrative depended on the assumption that the largest holders would never sell. That assumption expired in writing on May 5th, 2026. The press release sells you the dividend strategy. The earnings call tells you the truth. Even the most committed corporate Bitcoin holder on earth has a price at which the math forces a sale. And that price is now publicly anchored to a 1.22 MNAV threshold and an 18-month preferred dividend runway. Whether you read this as a structural warning or a long overdue dose of reality, the action items are identical. Watch the on-chain flows from the labeled strategy cluster. Track the MNAV multiple weekly. Monitor the STRC issuance pace. Question the concentration risks inside every wrapper you hold. And ask yourself whether the executive promising you that he will never sell has the legal and financial flexibility to keep that promise when the dividend obligation comes due in 2027. So here's the question I want answered in the comments down below. Is Saylor smart for finally adding strategic flexibility to a treasury model that needed it? Or has the entire corporate Bitcoin treasury thesis just been quietly proven structurally broken by the single executive who invented it? Get highly opinionated in the comment section below, because this is one of those moments where the answer genuinely matters. And if you want to understand exactly how the STRC, STRK, and STRF preferred shared stack actually behaves under stress, what the conversion mechanisms actually look like, and which tranche is most exposed if the dividend obligations break, then you should definitely check out our full deep dive on Strategy's capital structure right over here. Thank you all so much for watching, and I'll see you again very soon. It's Lewis signing off.